Have you ever noticed something that looks incredibly calm, maybe even a little quiet on the surface, but you just know there's immense power building right beneath it, like a deep ocean current, or maybe a sleeping volcano? Well, that's exactly the kind of surprising observation that kicks off our deep dive today. We're taking a really comprehensive look at the state of Ethereum as of Q2 2025. Our mission here is to cut through all the headlines, the daily market noise, examine the actual data, and reveal the powerful underlying forces that are truly at play. And right up front, here's the core theme, the paradox. Ethereum is at a really interesting inflection point. What's striking is this huge difference, this divergence between its fundamental strength. We're talking all-time highs in stake ether, historic whale accumulation, record low supply on exchanges, stuff like that. And then its market price, which has been kind of hovering, roughly in the $2,500 range. This tension, as our sources highlight, suggests the market is coiling under immense pressure. It's quite a statement. Okay, let's unpack this apparent contradiction then.
On the surface, the price of Ethereum has been, well, a bit stagnant, right? It's largely been stuck between, what, $2,400 and $2,600. Yeah. What's going on there, especially when we consider all these other powerful signals we're hearing about?
You've hit on the central puzzle, yeah. This sideways movement, it follows that significant 45% rally we saw back in May. And now it's in a state of what you could call tense equilibrium. Buyers are consistently defending a support zone right around, say, $2,450 to $2,485. Some analysts are even calling it a potential triple bottom, which suggests pretty strong foundational demand there.
Okay.
But equally, sellers are capping any rally attempts near the $2,550 to $2,660 resistance area. It's a real tug of war.
So it's really locked in a tight range. Does that tell us anything about what might happen next, or is it just stuck?
Oh, it tells us a lot about the potential for what happens next.
Yeah.
When you see this kind of tight range, it actually means volatility is decreasing.
Yeah.
We're seeing narrowing Bollinger Bands on the charts. For those unfamiliar, that just indicates the price is trading in an increasingly tight channel. Think of it like a spring being compressed.
Right.
This, combined with the incredibly low 30-day price volatility we've seen, just 2.99%, is a classic signal of a squeeze. It suggests potential energy is building up, a lot of it, and we're likely to see a sharp, powerful price expansion in either direction pretty soon. The market is effectively coiling. Yeah, like that spring, just ready to uncoil.
That definitely sounds like a lot of potential energy building. Are the technical indicators confirming this compression, this potential for a big move?
They are, but it's a nuanced picture. Your short-term indicators, like the RSI.
Relative Strength Index.
Exactly. And MACD, the momentum indicator, they're showing indecision, maybe conflicting signals, which perfectly mirrors that sideways price action we've been talking about.
Makes sense.
However, and this is crucial for the bigger picture, the price remains firmly above the long-term 100-day and 200-day moving averages.
Okay.
These MAs smooth out price data, help identify trends. So being above them strongly suggests the medium to long-term uptrend for Ethereum is structurally intact, despite the short-term consolidation, yeah. And a key event long-term investors are keeping an eye out for is a potential golden cross.
The classic bullish signal.
That's the one, where the 50-day MA crosses above the 200-day MA. Still watching for that.
But zooming out, just looking past the daily wiggles, the report points to some powerful patterns, things that suggest a much larger story is unfolding.
Absolutely. When you pull back, look at the bigger canvas, you see these dominant bullish chart patterns emerging. The most commonly cited one is a large-scale ascending triangle or maybe a bull flag formation.
Okay, classic continuation patterns.
Exactly. Classic bullish continuation patterns. A confirmed breakout from those implies measured moves targeting around $4,100. Some broader macro analyses even suggest an $8,000 target in the longer term, though that's, further out.
Wow.
We also see an inverted head and shoulders pattern on the daily chart.
That's usually a reversal pattern, right?
Yeah.
Bottoming out.
Often indicates a reversal from a downtrend to an uptrend, yeah. Its neckline is around $2,824. If that breaks and holds, it projects a target of about $3,237. So you have this compelling contradiction, short-term indecision, noise, but a distinctly bullish, larger market structure underneath it all.
So if the market price isn't really telling the whole story, then this next piece, the on-chain data, this becomes super crucial, right? It seems like beneath the surface, there's a powerful, undeniably bullish narrative unfolding. What are we seeing with exchange net flows?
The exchange net flows are telling a really clear story. Aggressive accumulation. Now, there have been brief periods of net inflows, sure, but the dominant overarching trend, significant, persistent net outflows of ETH from centralized exchanges.
So people are moving ETH off exchanges.
Exactly. The total balance of Ether on all exchanges has actually plummeted to a multi-year record low. Right now, it's approximately 16.33 million ETH.
16.33 million, that sounds low.
It is, and it's not just a number, it's a critical signal. It indicates long-term investors are aggressively moving their ETH off trading platforms, moving it into secure long-term storage or into staking.
Taking it out of circulation, essentially.
Pretty much, effectively creating a massive supply squeeze that could dramatically impact future price movements. Less ETH available to trade means potentially more volatile upside when demand does arrive.
And it's not just, everyday investors doing this.
Yeah.
The report talks about whales. There's massive holders making historic moves. Can you give us some of those eye-popping numbers?
Oh, the accumulation by Ethereum's largest holders has been nothing short of historic. Really quite something. On June 12th alone, wallets holding between 1,000 and 10,000 ETH, they added over 871,000 ETH in a single day.
871,000 ETH in one day.
Yep, that was the largest daily accumulation by that specific group since the big bull market of 2017.
Wow.
And we've seen prominent individual whales acquiring massive amounts too, like one bought 85,465 ETH, worth about $221 million at the time, in a single week. Another one purchased 11,500 ETH, roughly $29 million, in just 4 days. In aggregate, if you look at whale and shark wallets, slightly smaller, large holders, they've added over 1.49 million ETH to their balances just in the past 30 days. These are the big players making significant conviction-driven moves. They believe in the long term.
So the big players are definitely buying, but what about the smaller ones? The retail investors, are they joining in this accumulation party?
Well, in contrast, retail activity actually appears to be waning a bit. While we've seen an uptick in new address creation, the number of active retail addresses, that plunged by over 55% in just 1 week recently.
55% drop. That's huge.
It is. It highlights a significant rotation of capital, maybe interest. Whales have increased their control now to approximately 27% of the total circulating supply.
Almost a third.
Getting close. And even more telling, these accumulation addresses. These are wallets that only receive ETH. They have no history of selling.
Diamond hands, basically.
You could say that. They've reached a new all-time high, holding a combined 22.8 million ETH.
22.8 million.
Yeah. And this growing concentration among large holders is also reflected in Ethereum's Gini coefficient. It's up to 0.7630.
That measures wealth distribution, right? Higher means more concentrated.
Exactly. For context, Bitcoin's is around 0.47. So Ethereum's number shows a significantly higher concentration among these strong hands, as they're often called.
Okay, so this systematic absorption of supply by these strong hands, it leads us to another massive fundamental strength you mentioned, staking. The network's security model seems to have really matured, becoming incredibly robust, right?
It absolutely has. We're seeing unprecedented levels of ETH locked in staking contracts. It just surpassed an all-time high of 35 million ETH.
35 million ETH staked.
Yep. That represents nearly 29% of the total circulating supply, effectively removing a huge portion of ETH from active trading and making it a productive yield-bearing asset instead. The number of active validators has also grown significantly. It's over 1.08 million now, with over $91 billion worth of ETH securing the network at current prices. Well, a malicious 51% attack has become economically irrational and practically impossible to execute. It makes Ethereum one of the most secure computing networks globally. It's a real testament to its increasing resilience.
And the Pectra upgrade back in May 2025, that sounds like it was a game changer specifically for institutional stakers. You mentioned EIP 7251. How does that specifically change the economics for a major institution trying to stake, say, millions of dollars worth of ETH? What was the big hurdle before?
That's a great question. Before Pectra, specifically EIP 7251, which is just an Ethereum improvement proposal like a blueprint for network changes, a single validator could only have an effective balance of 32 ETH. That was the cap.
Okay, 32 ETH per validator.
Right. So imagine an institution wanting to stake, let's say, 10,000 ETH. Before Pectra, they would need to set up and manage 312 separate validator nodes.
312, that sounds like a nightmare.
It was a massive operational headache. High hardware costs, constant monitoring, lots of management overhead. A real barrier. EIP 7251 dramatically raised that maximum effective balance for a single validator all the way up to 2,048 ETH.
from 32 to over 2,000.
Exactly. So now, that same institution with 10,000 ETH, they only need to manage about 5 validator nodes, not 312.
Wow, that's a huge difference.
Huge. It drastically reduces operational complexity and costs potentially by up to 98%. It's a massive step towards making large-scale staking much more efficient and accessible for traditional finance. It removed that previous barrier of fragmentation and complexity.
Okay, so this institutional-friendly upgrade feels like it was perfectly timed with another truly monumental development for Ethereum.
Yeah.
The launch of spot ETH ETFs, the exchange-traded funds in the U.S. How are these two pieces fitting together? And what's the immediate impact we've seen from the ETFs?
They're fitting together like perfect puzzle pieces, really. The timing was pretty remarkable. The debut of these spot ETH ETFs has been a resounding success so far. Between May 16th and June 12th, these newly launched ETFs recorded an extraordinary 19 consecutive trading sessions of net inflows.
19 days straight of money coming in.
19 straight trading days, yeah. During that period, they collectively attracted nearly $1.4 billion in net new assets. That signals persistent buying pressure, mainly from institutional asset managers accessing ETH through this regulated vehicle.
And is there a leader among the ETF providers?
Yes, BlackRock's iShares Ethereum Trust, ticker ETHA, has emerged as the clear market leader. It captured almost 70% of those inflows.
70% for BlackRock alone.
Yeah. And critically, this strong demand for ETH ETFs coincided with a period where spot Bitcoin ETFs actually saw net outflows.
Oh, interesting. So money leaving Bitcoin ETFs while flowing into Ethereum ETFs.
It suggests a potential strategic rotation of institutional capital. It seems institutions are increasingly recognizing Ethereum as a distinct and valuable asset class beyond just Bitcoin, and now they have an easy, regulated way to get exposure.
What's truly fascinating here is seeing how all these different pieces connect, isn't it?
Yeah.
You got the Pectra upgrade, making staking way easier and cheaper for institutions, and then boom, the ETFs launch, providing this clear, regulated path for institutional capital to actually flow in and buy ETH. It really sounds like Ethereum is solidifying its transformation into a proper institutional-grade yield-bearing asset.
That's a very accurate way to put it. The foundations are being laid for that transition.
So beyond the core Layer 1 blockchain, what's happening with Layer 2 solutions, L2s? The report calls them the undisputed engine of user growth and transaction volume. What does that actually mean for the average user trying to interact with crypto?
It means that while Ethereum's Layer 1 provides that ultra-secure settlement layer, the Layer 2s are where the vast majority of everyday user activity is actually happening now. They offer the speed and, crucially, the low costs that are necessary for mainstream applications to even be viable.
Right, because using Layer 1 directly can get expensive.
It can, especially during peak times. Among the leading L2s, Arbitrum still leads in total value locked, or TVL. That's the total value of assets deposited in its DeFi protocols. It's over $12 billion on Arbitrum. Optimism follows with around $6 billion. But the one growing incredibly fast is Base.
Coinbase is L2, right?
That's the one. Base has actually surged to become the leader in 30-day transaction count. It processed 53.1 million transactions recently, and it's now nearly tied with Arbitrum in terms of active users. This is where crypto feels fast and affordable for regular people doing everyday things.
And how did that Pectra upgrade specifically help these Layer 2s? Did it benefit them too?
Oh yeah. Pectra delivered significant benefits for the L2 ecosystem as well, particularly through the advancement of something called Account Abstraction. That was EIP 7702.
Account Abstraction. Sounds technical. What does it do for the user?
Imagine if your crypto wallet was as easy to use as, say, Venmo or PayPal. That's the goal. Account Abstraction makes Ethereum wallets feel more like smart accounts. It provides a vastly improved user experience. For example, you can now potentially pay transaction fees in stablecoins, like USDC, instead of needing ETH just for gas.
Oh, that's huge. Not needing ETH just to do something.
Exactly. You can also batch multiple operations into a single transaction, saving fees and hassle. And it enables things like social recovery for your wallet, which makes losing access less catastrophic for average users. It removes major points of friction, especially for people new to crypto.
Definitely sounds more user-friendly.
And Pectra also made it cheaper for the L2s themselves to post their transaction data back to the main Ethereum chain for security. That cost saving directly translates into lower transaction fees for the end users on networks like Arbitrum and Base.
I see. So cheaper for the L2, cheaper for the user.
Correct. As a result, the vast majority of DeFi, decentralized finance, and NFT trading volume now actually occurs on these L2s. The entire Ethereum ecosystem, L1 plus all the L2s, processed an immense $136.8 billion in decentralized exchange volume over just a 30-day period recently. Massive scale.
Okay, so if we connect all of this internal strength, the staking, the L2 growth, the upgrades to the bigger picture, the external environment, things like regulation and macroeconomics, they used to be a major headwind for crypto, didn't they? But it seems like that might have turned into a significant tailwind now. What's changed with U.S. regulation specifically?
There's been a material and generally positive shift. It feels quite different than a year or two ago. The SEC, under new leadership, has established a dedicated crypto task force. That signals a move towards creating a comprehensive framework, hopefully, rather than just relying on enforcement actions after the fact.
More proactive, less reactive.
That seems to be the aim. And a pivotal development happened on May 29th, 2025. The SEC staff clarified that certain forms of protocol staking, the kind Ethereum uses, do not constitute the offer and sale of securities.
That sounds like a big deal. Removes some legal uncertainty.
It removed a massive cloud of legal ambiguity that had hung over the industry, especially proof-of-stake networks, for years, huge relief for many projects. Furthermore, the U.S. Senate passed the Genius Act, which aims to regulate stablecoins, and the current administration has publicly stated its goal is to foster a supportive environment for the digital asset industry. So the overall tone has shifted, providing much-needed clarity and, frankly, legitimacy.
Is this a global shift, though, or just something happening in the U.S.?
No, this positive momentum, or at least momentum towards clarity, is mirrored globally. Europe's big markets in crypto assets regulation, MiCA, is now fully implemented. That creates a harmonized rulebook across the entire EU.
One set of rules for everyone there.
Right. And key Asian financial centers like Hong Kong and Singapore are also solidifying their regulatory frameworks for crypto businesses. Now, these regulations are often strict, make no mistake, but their clarity is actually a net positive. It attracts the conservative, mainstream institutional capital that absolutely needs regulatory certainty before they can participate in a meaningful way. So yeah, it's a global trend towards clearer rules.
Okay, regulations looking clearer, maybe more favorable. What about the broader economy? How is that influencing things?
The macroeconomic picture has also turned generally more favorable for assets like Ethereum recently. The latest U.S. Consumer Price Index, the CPI data for May 2025, came in softer than people expected. That eased inflation concerns a bit.
Inflation cooling off is good news.
Generally, yes. The Federal Reserve has held interest rates steady for now, and markets are increasingly pricing in potential rate cuts later in 2025. Lower inflation and the prospect of falling interest rates. That's historically bullish for risk assets, right? Things perceived as higher growth potential.
Like tech stocks, maybe crypto.
Exactly. And Ethereum has shown a pretty positive correlation with assets like the NASDAQ Tech Index, so it tends to benefit when the broader market rallies on that kind of news. Now, we should acknowledge geopolitical tensions, particularly in the Middle East, they do remain a potential short-term headwind. That's always a risk factor. But the underlying economic picture looks, let's say, more constructive than it did maybe 6 months ago.
Okay, so fundamentals strong, institutional interest growing, regulation clearing up, macro picture maybe improving. What does all of this mean for what happens next? Let's talk about market sentiment. It sounds like while institutions are quietly accumulating, the retail crowd, the everyday traders, are feeling a bit apathetic.
That's precisely it. The prevailing mood among retail traders and what you see reflected on social media is one of apathy and uncertainty. Kind of boredom, almost. There was data from a sentiment analysis firm on June 20th. It showed the ratio of positive to negative social media comments about Ethereum was nearly an even split. Just 1.03 bullish comments for every one bearish one. Very neutral, almost flat.
So no euphoria, but no panic either. Just blah.
Exactly. Blah is a good word for it. This sluggish sentiment, characterized by impatience, it's often seen as a contrarian bullish signal.
How so?
Well, historically, market bottoms or long consolidation phases before a major rally. They're frequently marked by this kind of retail apathy. It's often when the smart money, the long-term players, are accumulating from those who are just tired of waiting for something to happen.
Interesting. So the boredom could actually be bullish.
Could be. It's a pattern often observed.
And what about the derivatives market? Futures, options. What's that telling us about how traders are positioned for the next big move?
The derivatives market. That reveals a highly leveraged, but interestingly, directionally neutral landscape right now. Open interest, that's the OI, the total number of outstanding futures contracts has surged to near record levels. It's approaching $40 billion for Ethereum.
$40 billion in open futures contracts. That's huge leverage.
It indicates a massive amount of leveraged capital is positioned, yes, bets are being placed. However, funding rates, those are the periodic payments made between the longs and shorts to keep the futures price close to the spot price. They're hovering near neutral, around plus 0.0045%.
So roughly equal numbers betting up versus betting down.
It suggests no overwhelming bias towards long or short positions right now, despite the huge amount of leverage deployed. This combination, record high open interest with neutral funding rates, creates what some analysts are calling a powder keg scenario.
A powder keg. Because there's tons of leverage, but no clear direction yet.
Exactly. The market is packed with leverage on both sides. It makes it inherently unstable and prone to extreme volatility once a catalyst finally pushes it one way or the other. We've seen evidence of this fragility recently. There were $140.94 million in long liquidations during a dip below support.
Hoping out the longs.
But then, during a brief rally above $2,670 resistance, there was a massive $500 million short squeeze.
Wiping out the shorts just as quickly.
Precisely. It shows how quickly and violently the market can move when that much leverage gets caught offside. It's a very fragile balance at the moment.
Okay, so putting it all together, we have these strong fundamentals, growing institutional demand, the regulatory tailwinds improving, but also this highly leveraged coiled derivatives market. What are the likely scenarios for Ethereum's price in the short term, say the next few months, and then maybe looking at it a bit further?
All right, let's break it down. Short term, meaning less than 3 months, it's fundamentally about the breakout battle from this tight range we discussed, the bullish scenario. That would likely be triggered by a decisive daily close above that critical $2,825 resistance zone. And you'd want to see high volume confirming the move.
What could cause that break upwards?
Potential catalysts could be continued strong ETF inflows, maybe surprisingly dovish statement from the Federal Reserve hinting at rate cuts sooner, or perhaps positive developments regarding the possibility of staking within the ETFs themselves.
And the outcome if that happens?
That would validate those bullish chart patterns we talked about, the ascending triangle, the inverted head and shoulders. It would likely trigger a significant short squeeze, given that powder keg of leverage. That could rapidly propel the price towards $3,000, $3,200, potentially even $3,500 relatively quickly.
Okay, that's the bull case. What's the bearish trigger?
On the bearish side, the trigger would be a sustained close below the crucial $2,450 support floor. A clear breakdown.
And what might cause that?
Could be prompted by the opposite catalysts, right? A surprisingly hawkish Fed statement pushing back on rate cuts, a significant geopolitical escalation, or maybe an unexpected major regulatory setback, despite the recent positive trend.
And the outcome there?
That would invalidate the bullish patterns. It would likely trigger a cascade of long liquidations, wiping out the leveraged longs this time. Price could potentially fall towards $2,250, $2,300, or maybe even retest the $2,000 level in that scenario. So yeah, it's a moment of significant pressure with outcomes diverging sharply.
Very clear fork in the road in the short term. What about medium to long term, say 6 months to maybe 2 years out?
Looking medium to long term, say 6 to 24 months, the institutional bull case becomes very compelling based on the analysis. The primary growth catalysts are expected to be sustained demand from those spot ETFs, that deepening supply squeeze we keep mentioning. From staking removing supply, whales accumulating, and also the EIP 1559 burn mechanism continuously reducing supply.
Right. The burn is still ongoing.
Still ongoing. Plus, the ongoing adoption and impact of the Pectra upgrade especially. Account abstraction making things easier for users, and the improved institutional staking attracting more capital. And finally, the continued maturation and growth of that Layer 2 ecosystem, bringing in more users and activity.
And with those catalysts, what kind of valuations are being discussed?
Given those powerful structural drivers, projections commonly range from around $5,000 per ETH up to potentially as high as $10,000 per ETH by the end of 2025 or perhaps into early 2026.
$5,000 to $10,000. Quite a range, but significantly higher than today.
Significantly. Of course, there are key challenges to watch. A major regulatory reversal would hurt. A severe macroeconomic downturn would likely impact all risk assets. And there's always the possibility of unexpected technological competition, though Ethereum's network effect is very strong now.
So wrapping it up, for the long term, it really does look like a potentially strong asymmetric opportunity, doesn't it? You seem to have downside cushioned by these growing fundamental supports, but maybe explosive potential on the upside if these catalysts play out.
Exactly. That's what the analysis overwhelmingly suggests. That's the core thesis. The downside appears cushioned, relatively speaking, by its fundamental strengths, that massive staked base acting as a committed floor, a vibrant and productive DeFi economy built on top, and that growing base of dedicated long-term holders and accumulation addresses. The upside, in contrast, looks driven by this confluence of really powerful structural catalysts, things that have the potential for exponential price growth as these trends fully play out over the next year or two.
Okay, so as we wrap up this deep dive then, Ethereum in Q2 2025 is really defined by this powerful divergence, isn't it? You have these unequivocally bullish on-chain fundamentals, technological underpinnings stronger than ever.
Record levels of ETH being staked, accumulated by high-conviction investors, creating this historic supply squeeze.
Right, and simultaneously the launch of spot ETFs and a more favorable global regulatory shift have unlocked this new, persistent stream of institutional demand.
And that tension between the immense fundamental strength and the indecisive short-term price action has created that coiled spring we talked about. It's setting the stage for heightened volatility, sure, but also the potential for explosive asymmetric price growth.
So the key takeaway for you, the listener, seems to be focus on the story behind the stagnant price. Look deeper, particularly the why. Why is the smart money accumulating now?
Think of the ETFs as a persistent, long-term demand shock meeting, that deepening supply squeeze. That's a powerful combination. And remember Pectra and the layer 2s. That's the quiet but incredibly powerful bull case unfolding. They're making ETH a foundational technology for a genuinely growing digital economy. Account abstraction creating that Venmo-like user experience that could unlock whole new waves of adoption.
So, the analysis suggests that while the path forward will undoubtedly be volatile, you have that powder keg in the derivatives market ready to go off. The fundamental case for significant appreciation in Ethereum's value seems stronger now than at perhaps any point in its history.
That seems fair to say based on the data, which leaves us with a final provocative thought for you to consider. How will this digital Manhattan, as some have called it, continue to reshape the global financial landscape as it moves further from pure speculation towards real-world fundamental utility and broad institutional adoption? Something to mull over.